Kenny, thoughts right now, and how much of the experience from past episodes like SARS are informing what traders are doing today?
Well, you have to, each one of these is different. What we saw in SARS back in 2003 was the market that backed off about 12% over a period of time as kind of that whole virus took hold around the world. The same, I suspect, is what's going to happen here. You can see it starting on Friday. You see it now continuing today. And as the headlines continue to be as negative as they are, you're going to get some more angst. And so, look, I think this will come under control, but until it does, there will be that angst. But it also, this gives the market really a reason to kind of back off. We've been talking about this for a while now. The market's done nothing but go straight up with absolutely zero kind of pullback. And so negative headlines like this, really give everyone a reason, take a breath, take some money off the table, and let everything come back to settle in. I would be of the mindset, kind of sit back, watch this happen. Don't jump right in to buy something just because, you think the market's down 1.5% today. We could go down another 4 or 5% the next couple of days. So no reason to rush. Just be patient.
Yep. Lou, that's clearly Morgan Stanley's stance today. They say that the sell-off will be contained at 5% or less, in part because there's so much liquidity washing around the U.S. and around the world. What do you make of that?
It's really hard to quantify the extent of the potential sell-off. I mean, we've seen these types of issues with the market before, whether it's coronavirus, SARS, Ebola, Legionnaire's disease, right? I mean, this stuff tends to crop up every now and then, and typically they stay in the headlines for a few weeks, and then kind of it peaks out, 3-4 weeks into it, and hopefully that's the case with this. So, again, it is a headwind to stocks, and like Kenny said, I really agree with that assessment that, the market is likely to sell off with these negative headlines, particularly because we've had this strong run-up uninterrupted for like 6 months now. And so, again, we can expect this pullback. But it's important to identify, kind of great long-term opportunities and be ready to pounce when they come in your area to invest in. And that's been our strategy at Eaton Vance.
Kenny, what's big tech's role in this environment? I mean, Apple and Microsoft both report earnings this week, by the way, but they contributed nearly 15% of the S&P's gains last year, 25% of the Dow's. Do we have to really look at them and see how much of these coronavirus concerns and other issues echo in their earnings to know what to do from here?
Well, listen, I'm not sure that the coronavirus itself is going to echo in one of their earnings, at least in this earnings report, right? But I think what you have to be wary of is with the market kind of in this negative tone that we're in this last couple of days and what could be, another week or so of kind of angst and nervousness. When they report these numbers, considering Apple, look, Apple's was up 125% last year. It was up 47% in the last quarter alone in anticipation of Christmas and the holidays and the wearables and the cloud service and all that stuff. If they come out on Wednesday or Thursday this week when they announce and they miss any one of those numbers, it's just going to give everyone a reason to say, you know what? Let me take some money out of Apple. And it would make perfect sense because it's gone straight up. Again, I don't think people should really make too much of it because it'll be more the trader types that are doing that. The long-term investors will take it in stride and then use it as an opportunity. But don't be surprised if that happens where we had this kind of buy the rumor, right, ahead of holiday season and the shopping, and then sell the news when it comes out, especially in an environment that's a little bit anxious right now.
Yeah, Kenny, I'm just thinking about the guidance. Apple does, we got to remember, have 42 stores listed on its website in mainland China. That's a lot of employees. That's a lot of people wearing masks, perhaps not going out as much, and you wonder if it affects their guidance at all.
Well, it might affect their guidance, but look, a lot of the tech suppliers, too, that supply to Apple that are in that part of the world are also probably going to be put on hold a little bit. So you might get some concern about that. But here's the deal. If we're all living this right now, so we know that we're having this conversation, you're kind of half expecting that that's going to happen. And so they're going to take some of that out of Apple now, and maybe even ahead of what they announce. And so I don't think anyone should be surprised about that at all. But, yeah, you do have to understand that that's possibly going to be part of the narrative that you hear on Wednesday or Thursday when they come out with their earnings, in kind of an anticipation, trying to prepare, investors in the market that potentially this could really affect them in the next quarter. But we'll see.
Hey, Lou, speaking of Wednesday, that's the date we're going to get a Powell presser. The thinking going into this Fed meeting had been, well, maybe this is a chance for Powell to address the debate about whether or not increasing balance sheets are driving asset prices. Does the coronavirus now push at least the qualitative commentary on Wednesday onto the dovish side?
Yeah, I mean, I think the Fed has been and will continue to be on the sidelines at least through the end of the year. I don't think this changes anything. It may, look at the end of the day, if the global macro starts to face some headwinds because of this in the short run, again, that gives them more impetus to continue to stay on the sidelines. So we think that's certainly the case. But how it relates to stocks, I mean, obviously there's certain areas and industries and exposures that are more important than others. And I think you have to be patient in picking your spots to those areas that have those kinds of exposures. But again, this will create a really good opportunity for those companies with good long-term fundamentals and secular growth areas to pick them up at much more reasonable valuations.
Yeah. Kenny, one last point. You mentioned how these episodes don't necessarily repeat. They rhyme in a way. Our producer, Patty Dom's done some work on how the bond markets reacted to the coronavirus. And yields moved sharper this time than it did in the early days of SARS, getting some help there from Wells Fargo. I wondered, how should investors absorb that?
It's interesting because I was trying to go back and remember what the headlines were like when SARS hit in 2003 versus the headlines that we've seen over the last couple of days. And for some reason, I'm getting the sense, and maybe it's just because technology is further along, the internet, LinkedIn, Facebook, all the kind of news sources are further along today than they were in 2003. But the headlines appear to be more negative to me, right? Like over the weekend when China came out, Xi Jinping came out and said, it's a crisis and it's spreading out of control. Those are kind of really hot headlines. And for some reason, creating certainly more angst in the marketplace. And I think creating more angst than what SARS did. And so to see that move in treasuries, that flight to safety in gold and in utilities and in treasuries, I think made some sense. But I think it's the tone of the headlines and the speed at which those headlines travel that's kind of causing that reaction.